Larry Fink, a legendary figure in the financial world, has had a career full of twists and turns, from a successful start in the career to a major setback, to founding BlackRock and turning it into a global financial giant. His experience has profoundly affected the financial landscape of the United States and the world. In the 1960s, when California was in the midst of a wave of social change, Larry Fink enrolled at UCLA to pursue a degree in political science and then an MBA. He joined an investment bank as a bond trader in the early 1970s, when the bond market was just beginning to trade actively, and Fink quickly rose through the ranks as the youngest manager in his department. He saw the mortgage market take off when he was Freddie Mac's first bond trader. In 1982, when his trading desk was equipped with a computer, he realized that he could use it to analyze mortgage cash flow, which helped his bank become the most profitable bank in Boston from 1983 to 1985. In the 1980s, when President Ronald Reagan cut taxes and deregulated Wall Street, financial innovation boomed and mortgage securitization emerged. Fink, one of the architects of this innovation, sold the newly issued securities to large investors, generating huge fees for First Boston, and the company generated $1 billion in profits, making him the company's most profitable man. However, in 1986, the year before the Black Monday crash, he was part of a team that lost $100 million in a single quarter. Despite all his previous successes, the massive losses tarnished his reputation, sidelined him, and eventually forced him out of the company. Unemployed and struggling to raise money, his career prospects were bleak. After leaving First Boston, Fink decided to start his own company. In 1988, he met Steve Schwarzman, the founder of the Blackstone Group. Blackstone, then a little-known advisory firm, was planning a wealth management business. Schwarzman saw Fink's abilities, and the two invested $5 million together to form Blackstone Financial Management. In the course of his operations, Fink recognized the importance of risk analysis in the fixed income space, and his firm achieved initial success by focusing on it. But tensions flared after Mr. Fink and Mr. Schwarzman clashed over the direction of the company, particularly over stock options to attract talent and Blackstone's ownership. In 1991, PNC Bank offered to buy Blackstone's asset management business for hundreds of millions of dollars. Schwarzman eventually agreed to the sale, a decision that turned out to be a major misstep as the breakaway BlackRock grew into a financial giant that dwarfed even Blackstone. In 1994, BlackRock emerged from Blackstone as a relatively small firm, but Mr. Fink was determined to find a competitive edge. The investment bank GE bought at the time was caught up in insider trading and accounting fraud, and its holdings of $10 billion worth of mortgage securities, CMOS, became a thorny, toxic asset. Fink led the team through financial engineering, revaluing and packaging those assets to help GE unload them gradually and recover value with minimal loss. The move catapulted BlackRock to prominence on Wall Street, growing its assets under management from $8 billion to $46 billion in just 3 years. BlackRock went public in 1999 to become the fifth largest publicly traded asset manager in the U.S., and has continued to grow rapidly since then, amassing $400 billion in assets by 2008. In 2008, the global financial crisis caused by financial derivatives broke out, and many financial institutions fell into trouble. The government asked J.P. Morgan Chase to bail out Bear Stearns, and BlackRock, with its expertise in mortgage securities, participated in several major rescues. Mr. Fink's frequent calls on the likes of Mr. Paulson, Mr. Diamond, and Mr. Geithner to help orchestrate the financial rescue cemented his standing on Wall Street and made him its new king. After the financial crisis, the financial market has undergone profound changes. Issuing and trading fixed income derivatives is no longer a desirable business, and the spread of the internet has fueled the growth of social media and changed the financial landscape. Fink is acutely aware of the potential of index funds and ETFs, exchange-traded funds. BlackRock began aggressively buying ETFs, attracting a large number of small investors through low-fee ETF products. As of 2009, BlackRock controlled nearly half of the ETFs in the United States, raised a large amount of capital in a short period of time, became a major shareholder of many public companies, and its influence on the American economy was increasing day by day, and Larry Fink was also known as the JP of the 21st century. Morgan. Today, BlackRock continues to expand its business on a global scale, actively lay out in Japan, Mexico, and other countries and regions, and become an important force in the global financial field. At the same time, Fink is also more focused on exercising the power that BlackRock has, requiring the company to strengthen long-term strategic planning and board accountability, and further consolidate its position and influence in the financial community.